Good morning, Lou Brydges again, Lou Brydges and Associates. I've been asked to speak on 6 topics today, 6 questions that many viewers have had. And so we're going to divide these into separate segments, I guess. So let me just get right into it. The first question involves the FHA audits. Well, this is very interesting. And, you know, as my grandmother used to say, you know, the truth, it always has a way of surfacing. And the Inspector General of the United States, U.S. Department of the United States Department of Housing and Urban Development, HUD, recently conducted audits, very much like the audits that we've been using for about 3 years now. Now, we've developed our audits over the years. The audits we're using today are much more sophisticated than the ones when I first started doing this 3 years ago. They've developed and evolved, but I'm very proud to see that these audits are now being used not only by the Attorney Generals, who extracted an initial $26 billion from the banks based on what they found in these audits, but the Inspector General of the U.S. Department of Housing and Urban Development recently conducted audits and published his reports just this past month. They're all dated March 12, 2012. They audited over 4,000 foreclosures that have gone through. These are American families that have been dispossessed of their homes. And what they're looking for is whether these were correctly done. Because what these banks do, that are servicers of these mortgages, is they put through these foreclosures, and when they inevitably lose money, they then submit a claim to Fannie Mae or Freddie Mac, because most of these mortgages were backed by Fannie Mae and Freddie Mac. So if you have, say, a $300,000 mortgage, and the property is only worth $200,000 today, and we all know why that is. The foreclosure goes through, and at the end of the day, the bank sells the property at the on a foreclosure sale for $100,000. Well, they submit a claim for $200,000 to Fannie Mae and Freddie Mac, who backed these mortgages, which was a policy that, you know, whether you agree with it or not, it was a standard procedure for about 10 years. You know, Fannie Mae and Freddie Mac were backing all these mortgages as part of an effort to make home ownership available, but obviously was grossly abused by these banks, who saw it as an opportunity to just jack up the price of American real estate, to get as many mortgages for as much as they could, regardless of the value of the home. And then when there was an inevitable default and foreclosure, they would just go to look to the U.S. government to bail them out, which we did. But the Inspector General started looking at this and said, and found, and you know, they have these published reports that you can get online. The Office of the Inspector General, U.S. Department of Housing and Urban Development. We have one here for Bank of America. And these audits examine the foreclosure and claim process review. We have one here for Wells Fargo. We have one here for Citibank and J.P. Morgan Chase. And what these found and these are all the results of over 4,000 foreclosures that have gone through, and these banks have dispossessed American families of their homes. And this is what the findings were. The auditors found that these banks did not establish effective control over the foreclosure process. This failure, and I'm reading from one of the reports here, permitted, the one involving Bank of America, but they're all pretty much the same. This failure permitted a controlled environment in which affiants routinely signed foreclosure documents, including affidavits certifying that they had personal knowledge of the facts when they did not. That's a false affidavit submitted to a court. Specifically, affiants signed large volumes, this is the robo-signing you've heard about, of foreclosure documents without reviewing the supporting documentation referenced in them. They also consistently failed to verify the accuracy of the foreclosure documents they signed. Notaries routinely notarized documents without witnessing affiants for signatures. Attorneys improperly prepare documents and misrepresent the work they performed. Review of this claim shows that Bank of America did not consistently retain legal documents supporting the foreclosure. Analysis of the mathematical accuracy shows inconsistent per diem calculations, discrepancies, and also improper descriptions. And what it resulted in is that these banks, Bank of America, improperly, thereby misrepresenting its claims to HUD, and may have exposed it to liability under the False Claims Act. There's a law that prevents a party from making false claims against the U.S. government, and all these banks have been found, there's evidence that they have violated the False Claims Act by submitting claims to Fannie Mae and Freddie Mac, which are quasi-government entities, in violation of this False Claims Act. Now, I don't have to worry about any defamation lawsuit because all I'm doing is reading to you an official report published by the Inspector General of the U.S. Department of Housing and Urban Development. This is the same thing that our audits find, and the same thing that the Attorney General's audits find, that the banks do not have the documentation to put through a foreclosure. Now, this doesn't mean, although it does mean, it has been, and will mean in many more cases, that people will get their home free and clear of a mortgage. Don't expect that. Don't look for that. That would not be an equitable just. And remember, we're all about truth and justice. But the fact is that this $300,000 mortgage on this $200,000 property is an unfair situation that you were duped into, and that by a phony appraisal committed by an originator that was given tremendous incentives by the Wall Street investment banks to get as many and as large of mortgages as possible. The mortgage on the $200,000 house should be in the $150,000 to, at most, $180,000 range, so that you've got some equity in the property. And you do have equity in the property because you're the one that cuts the grass and trims the bushes and paints the gutters and maintains the property. That's called sweat equity. So what we do here in Brydges and Associates is we fight the foreclosure. We use the audits, and we put the bank in a situation where, look, you're either going to have to submit false documents to the court, in which case we're going to catch you, or you're not going to be able to put through the foreclosure, in which case the homeowner is going to stay in the home, or you're going to agree to a principal reduction. And we're going to give a fair result to this, a fair result based on the true fair market value of the property. So that $300,000 mortgage, you can take it and say rip it up. I'm going to try to be professional here. You can take it and rip it up and throw it in the garbage can. We'll substitute a new mortgage for $180,000. And until you do that, my homeowner, my client, is not going to leave the property. And I've got the audits from the Inspector General. I've got our own auditors that pioneered these type of audits. And these are the same audits that are being used by the Attorney Generals. Leading Eric Schneiderman from New York, Bo Biden from Delaware, Martha Coakley from the Commonwealth of Massachusetts, who I first heard the phrase that I've come to love, they may be too big to fail, but they're not too big to be held accountable under the law. Kamala Harris from California and Attorney General Cortez from Nevada are emerged as the leading attorney generals in this field, and they are using the audits that we pioneered the use of. And these audits are showing the same thing that our audits are showing. These banks do not own the mortgage. There's been a break in the chain of title. They have improper documentation. They have lost the documents. They don't have the note. There was a separation of the note and mortgage. The mortgage was not placed into the trust in the appropriate window period. It was not placed into the trust that's suing to foreclose. The party suing to foreclose does not own the mortgage. They're merely the servicer. And there was also misrepresentations and violations of the Real Estate Settlement Procedures Act and the Truth in Lending Act in the origination of the loan. And the originator actually was using an appraiser that gave him an appraisal for whatever he wanted so he could produce as many large loans as possible, which is appraisal misfeasance. That's a mistake. Appraisal malfeasance, that's an intentional wrongdoing. And that these appraisers failed to disclose a conflict of interest, which is a violation of Appraiser Licensing Act, which require appraisers to disclose any conflict of interest to the homeowner who might be relying upon the appraisal. So as you can see, there are a multitude of issues, and we have the evidence to support our positions. And if you, if you're underwater, or more of the property than it's worth, if you're in foreclosure, if you're facing foreclosure, if you're behind in your payments, I urge you to consult a foreclosure defense attorney who is familiar with audits and can explain to you the difference between a forensic audit, a securitization audit, and keeps up on the developments in this field. I'm not the only attorney doing this, but there is going to be, and there are a lot of scam attorneys out there who are going to jump on this bandwagon, so to speak, and hold themselves out to be experts. So you have to be very careful in hiring a foreclosure defense attorney. You might ask the attorney if he's heard of Professor Adam Levitin, the University of Georgetown School of Law, Georgetown University School of Law professor who has become the leading academic authority in the country. Ask the attorney if he's familiar with StopForeclosureFraud.com. And but whatever you do, do not give up your home. You have truth and justice on your side, and you can prove it with an audit.